Something unusual is happening in the mining industry, and unless you've been following every headline, there's a good chance you've probably missed it. Over the past 2 years, some of the biggest names in mining have opened their checkbooks in spectacular fashion. If we take a look at this, Rio Tinto spent $6.7 billion US to acquire Arcadium Lithium. BHP and Lundin Mining joined forces to acquire Filo. Equinox Gold and Calibre Mining merged to create a new major gold producer, and Anglo, American, and Teck, well, they've also pursued transformational combinations that could reshape the competitive landscape. Different companies, different commodities, different strategies. Yet they're all making the same move. So what's really going on here? Welcome to the Market Knowledge. I'm Lyndsay Malchuk. At first glance, these look like ordinary mergers and acquisitions. Every deal comes with its own investor presentation, its own strategic rationale, and its own promise of creating shareholder value. That's the story we usually hear. What if they're about solving a problem the mining industry has been quietly wrestling with for years? Now, to understand that, you have to go back to how the industry was built in the first place. For generations, the path to growth was remarkably straightforward. Mining companies explored, geologists searched for new deposits, drill programs tested promising ground, discovery projects became development projects, and development projects eventually became producing mines. It wasn't a perfect formula, but it was one the industry relied on for decades. Today, that formula is becoming increasingly difficult to repeat. The easiest discoveries have largely been made. New deposits are often deeper, more technically complex, and significantly more expensive to develop than they once were. Even when companies are successful, moving a project from discovery to production can take well over a decade, sometimes much longer. Meanwhile, the clock has never stopped ticking. Every operating mine has something in common. Every single day it produces ore, it also produces a little less of itself. Every truckload hauled to the mill is one truckload that will never come back. So that means every producing mine company is facing the same challenge. Whether it mines gold, copper, lithium, silver, or iron ore, how do you replace tomorrow what you're producing today? That's the question quietly driving boardrooms across the mining industry right now. And once you understand that, these billion-dollar acquisitions begin to look very different. Rio Tinto didn't simply buy Arcadium Lithium. It secured an established portfolio in one of the world's fastest-growing sectors rather than trying to spend years building one from scratch. BHP and Lundin Mining, well, they didn't just acquire Filo, they secured one of the most significant undeveloped copper districts in the world at a time when major discoveries of that scale have become increasingly rare. Even the proposed combination of Anglo, American, and Teck, well, that tells the same story. It's about assembling a stronger portfolio for the future because in today's mining industry, owning the next generation of assets may be far more valuable than hoping to discover them first. And that's why this wave of consolidation matters. These companies aren't simply buying mines, they're buying time. Years of exploration, years of permitting, years of uncertainty. In an industry where bringing a major mine into production can, like I said before, take well over a decade, acquiring the right asset today can dramatically change what a company looks like 10 years from now. Now, from investors' point of view, that changes the conversation in ways that extend far beyond the companies writing the billion-dollar checks. Junior explorers have always been viewed as high-risk, high-reward investments, but increasingly, they're being evaluated through a very different lens. It's no longer just about whether they can finance and build a mine themselves. It's about whether they've discovered something valuable enough that somebody else decides to buy it first. That has the potential to reshape exploration, project valuations, and even where investment capital flows over the coming decade. Now, of course, none of this guarantees success. We know this. Mining history is filled with acquisitions that looked brilliant on paper, but failed to deliver. Cost overruns, permitting challenges, operational issues, and changing commodity markets have really humbled some of the biggest names in the business. Writing a billion-dollar check is easy. Creating long-term value from it is considerably harder. But despite those risks, the industry's largest companies continue to make the same calculation. They believe the cost of missing the next great asset may now be greater than the cost of paying a premium to own it. So the next time another mining acquisition makes headlines, don't stop at just the purchase price. Ask yourself what the buyer is really acquiring, because chances are they're not just buying a company, they're buying years they no longer have now. I'm Lyndsay Malchuk, and this has been your Market Knowledge.